All right, so I think we'll just get started with this session. So as I said, this is Thematic Track 6, Bringing Price Transparency in Global Carbon Marketplace. This session aims to explore the importance of price transparency in carbon markets and the need to digitalize the over-the-counter transactions through the digital platform. The focus areas of discussion will be on challenges, potential solutions, and future advancements for achieving transparency in the global carbon marketplace, leading to certainty about the true market value of carbon credits. To start off the session, we have our chair and moderator who I would like to invite up on stage, Mr. Fabio Silva Neme, Global Head of Carbon Renew. Mr. Fabio is a Senior Executive Vice President and the Global Head of Carbon at Renew. In such capacity, he leads the development of Renew's carbon business. He has over 20 years of experience building and operating businesses in compliance and voluntary carbon markets and environmental commodity markets in Europe, Americas, Africa, and Asia. He's the co-chair of the India Task Force at IETA, chairman of the MCS Foundation, a UK not-for-profit decarbonizing the built environment, and a member of several industry initiatives to advance carbon and environmental markets. Can we have a round of applause for our chair and moderator, please? I would now like to call upon our esteemed panelists for this session. First, we have Mr. Vishwajit Dhanukar, Director, Air Carbon Exchange. We then have Dr. Neha Jain, co-founder BNZ Green Technology. We have Ms. Nadia Nair, Strategy and Development Team Lead, Carbon Markets APAC, ACT Commodities. We have Mr. Amit Thusu, Senior Director, Global Carbon Council. And finally, we have Mr. Indraneel Chatterjee, Senior Vice President, International Carbon Exchange. Could we have a loud round of applause for all our panelists and our chair? Over to you, Mr. Fabio.
Good afternoon, everyone. Thank you very much for joining this Thematic Track 6. My name is Fabio Neme, Global Head of Carbon at Renew. I'm sure that all of us, having attended now the conference for a day and a half, we realize there are a lot of exciting topics in carbon, from 6.2, 6.4, and CORSIA, and CCTS, and so on and so forth. But I think, at least for me, there are few topics that are more exciting on the convergence of digital technologies and carbon markets. And the reason being because, the development of global, healthy, efficient carbon markets require, good data analytics, require efficient, project monitoring, and require connections between, buyers and sellers, many times across jurisdictions, require increasing even connection between countries, between registries, and, digital technologies can help accelerate the market, can amplify and expand the market. So today we're going to discuss a very important topic within carbon market, which is how we can bring price transparency, and as noted by the master ceremony here, in particular how technology can help bring price transparency and efficiency to carbon markets. Those that are familiar to carbon markets will surely know that there's a very widespread level of prices for the same ton of carbon. Within compliance markets, the market in Europe has a different price than the market in California, that has a different market than the price in the UK, for example. And of course, within the voluntary market, you even have a wider range, some projects in the low single digits, some projects getting over $100. So how can we develop a market that either converges, if not to a single global price, at least to a much narrower band that tries to value, the value of carbon in a simpler way, with less fragmentation. It's a very, I think, important question for the development of the market. Many other commodities were able to become really global commodities once this price discovery and efficiency was created. But let's not be afraid, because we have a rock star panel here with me today to discuss these topics. Here on my left, Ivish Dahanukar, who's director of ACX, which is a global exchange based on blockchain technology with operations in several jurisdictions. To the left of Vish, we have Dr. Neha Jain. She's the co-founder of BNZ Green Technology, which provides advisory services on carbon and also has a blockchain-based marketplace that was recently launched. We have to the left of Dr. Jain, Nadia Nair, who leads the strategy and development for ACT in APAC. ACT is a global trader with operations very substantial places in Asia, Europe, and North America. I'll note both in voluntary and compliance markets for carbon and other environmental commodities. To the left of Nadia, you have Amit Tussur. He's the Senior Director of Global Carbon Council. Global Carbon Council is one of the main registries for carbon, which, for those that are not necessarily from the industry, is a very key node in the market that develops methodologies for projects, issue credits, and has a very central role in the development of the market. And to the left of Amit, last but not least, Indranil Chatterjee, who is the Senior VP of ICX, the International Carbon Exchange, which the name is self-explanatory. It's been an exchange for carbon, but also importantly has been very involved, I think, in development of the power market in India, so has a lot of experience to draw from to the development of the carbon market. So with that, let's start maybe setting the framing a bit the issue. So Vish, let me start with you. You know, buyers and sellers in this market, they have to deal, as I was noting, with a lot of price fragmentation. What is their fair price for a given carbon credit? And you know, it's not an easy issue, neither for buyers, for sellers. So from your experience, can you share a little bit, you know, what are the challenges for the buyer, what are the challenges for the seller when we have such a fragmentation and lack of transparency on price? And also, how does that hinder the growth of the carbon market? Thank you for joining us.
Yeah, thank you, Fabio. Thank you for inviting me here. And I must say that the PE, along with AITA and the World Bank, have put together a fabulous conference. I think a key takeaway has been the level of enthusiasm and participation in this event. So to address your question, I think we have to understand how this market has evolved. And if you look at historically how this market has evolved, it evolved around a voluntary requirement for climate conscious companies to make their plans of trying to go carbon neutral. And with that, we have several registries and several methodologies which have developed over the last decade or so. The real challenge here is that unless the buyers get aligned to understanding that standardization is important and that, you know, credits of a standardized quality and nature, like we had back in the day with CDM or you have with the ETS, are essential, I think this wide variety of projects and hence the pricing around it is going to continue to stay. So one of the things is, of course, the attributes other than the ton of carbon, which are typically social impact and other attributes that the credits carry today, are significant sort of, you know, factors in which the pricing of these credits are determined. In addition to that, of course, geographies and vintages, etc., also play an important role in pricing. But I think the key here is that for buyers to understand that there needs to be a level of standardization. It's not just about, you know, something which is exotic or catches the eye of the marketing team that can be put out there. But I think that approach needs to change, and I think we are seeing that happen slowly with the integration of the voluntary and compliance markets, particularly now that we've seen Corsia permit some VCMs into the trading scheme, and we're seeing the UK and Singapore also acting on it. So I think standardization will happen, and once standardization happens, obviously you have better liquidity, and once you have better liquidity, you have better price discovery. So I think it's an evolving process, but I think really that challenge continues to stay there until the buyers and the sellers also reconcile to the fact that there needs to be better standardization.
Thanks, Vish. Nadia, do you want to jump in, given the activity ACT has in the market?
Yeah, with pleasure. But before I do, just good afternoon, everyone. I know it's after lunch, so thank you for being here. It's a pleasure to be with all of you here today, as well online somewhere. Yeah, maybe I just wanted to butt in to speak about price discovery on a few parameters, because I think price discovery needs to be distinct depending on the jurisdiction or the region. So let me try to break it down. There are different parameters towards price discovery. The first one, if you can think about, is supply and demand. So if we take into account nascent markets whereby there is lesser supply and whereby there's not a lot of strong demand, it's harder to get that price discovery. I'm going to sound childish when I say it, but price discovery is discovered based on transaction. So you need to have activity, you need to have data. Now, if you think about on a market level, so carbon market level, you have different layers of risk. And I'm not sure if you guys managed to attend the session yesterday with B0, where Sebastian mentioned there are counterfactual risk that you cannot account for. It's not tangible. And these risks that exist in the market will, of course, hinder price discovery, but there are certain layers to which you can prepare for that risk, as mentioned by him. The last one would be market mechanisms. There are different market mechanisms. On a compliance level, price discovery is there, transparency is there. On a voluntary level, the way it's been initiated, it's not that there's not a lot of price non-transparency, it is just the market condition has been driven in a bilateral manner. So I just wanted to make that distinction, and I hope that was clear. Thank you.
Thanks, Nadia. So let me add another layer here, which is between buyers and sellers, the kind of wider regulatory environment that we have. So, Ahmed, if I can come to you, GCC has been as a registry, is a bit of intersection of many parts of the industries, developers, methodology development, buyers, regulators, deciding to partner, have to connect with many exchanges and other registries possibly. So can you give us, from your standpoint, what is the kind of collaboration that's required, what regulatory initiatives are needed to try to support more transparency on the price, more efficiency on the price formation, so that we can at least narrow the wide range of prices that we have in the market today?
Yeah. Thank you for, first of all, inviting me, and good afternoon to all of you. So from the regulatory point of view, I think carbon as a commodity becomes a commodity and as a value once there, some kind of trust is attached to this whole thing. So you have to believe in that is a commodity and it delivers the value. So how this could be done is through a set of processes that is very standard in the carbon markets for regulators to have an efficient governance, to have I would say set of verifiers which are competent and can go to the site and can actually look at the projects and verify everything. Set of standards, methodologies that actually provide that kind of certainty of the measurements of the greenhouse gas emissions or any other environmental benefits that are associated with it, and the registry that actually carries out a transaction. So I think these elements together create that level of trust from the supply side. Of course, when you look at the carbon price, you look at you look at the abatement cost. If we drill it down, the abatement cost of the technologies, and then you add on the top of this is the transaction prices from the supply side, and then buyer's margin, or you can say the that element. So abatement costs are very standard in the market. We know the technology and we know what the costs are. We've been doing it for quite a bit of time. Also the supply side in terms of the cost of, well, say, validation or PDD development or identifying projects, and the registry cost, verification costs, and all also very, for last 20-25 years, this is quite popular, and this has been done quite a bit of time. So there is a good idea about this whole thing, how it works. Of course, in the new climate regime, we are in CORSIA phase 1. We are also in Article 6.2, 6.4 scenario. At this point in time, there would be new elements that probably will come up. We know that with CORSIA, corresponding adjustment, letter of authorization, there are high level of risks. Obviously, this will trickle down in the costs of the transactions also. For example, we've been recently approved under CORSIA, and the approach that CORSIA has taken is they have applied, they require a guarantee for corresponding adjustments to be provided before the credits can be issued. So which means that programs, there are two approaches that have been taken. One is that You apply a buffer approach, you make some deductions, and you create a fund, that will be used to for compensation in case the corresponding adjustment are not being applied. So that is the approach GCC has taken, and this is what TAB of course actually accepted, and ICAO accepted it. But there are other standards like VERA and Gold Standard and other standards. They have taken an approach of insurance. And we have been hearing that the insurance costs close to $3 to $4 per ton as of now, or they're making the news as of now. So the point I want to make is that I think there are those costs that will also add up. And also these days the countries are looking at credits being a sovereign assets, So they are also kind of looking at some kind of contribution or share of it. So I think this all is going to add up to the whole thing, and my understanding is that with these numbers, if we kind of use a rough approximation, we can see easily it going to close to $7 to $8 or $10, right? Sure. So obviously credits that will come up in CORSIA are going to be priced higher than that, right? Of course, it has to cover the bias risks, they have delivery risks, there are other risks, related risks, exchange rate fluctuation, and so on and so forth, I think. That is what I see. But in terms of the carbon markets, I see CDM supplied about 2.5 billion credits, VCM after 2012 supplied close to 1 billion. So I think at that scale, 90% of the transactions on the sales of credits are happening through the OTC, the over-the-counter, Only 5% probably are going through exchanges. So I think if we have to move in that direction of digitization so as to have the real-time, settlement processes, I think we also have to look at the scale, So it has to be really scale for those digital technologies to be financially attractive, so as to start investing, as we see in other mature commodity markets, that we have around, So yeah, this is it. Thank you.
No, thanks, Amit. So let me just maybe bring you in and build a bit on the Amit point and the point that Nadia and Navish shared. So we understand the fragmentation, and how it impact buyers and sellers. I think Amit discussed some of the elements, one of them being, the new elements of cost that come to the market, right? So, your company now has started a blockchain-based marketplace, and before that, you've been working with this technology and other technologies for some time. So could you share a little bit your sense of, how these technologies can address both the buyer and seller challenges of a fragmented market, and also, help reduce costs, right? So if all these elements new cost elements are coming to the market, how technology can at least help us compensate them partially?
Right. Thank you. Thank you, and good afternoon, everyone. Thank you for having me here, Fabio. And, we have been seeing that a lot of problems and challenges are there already in the carbon market. I'll rather start with the solutions that are there with us. Technology is one of the solutions that can bring a lot of change. I could rather say it revolutionize the pricing mechanism in the carbon market. One of the things that particularly I would talk about is blockchain and smart contract. Those are something that have the caliber to bring some kind of transparency and trust into the system. For example, like, blockchain, a ledger that, keeps record of all the transactions that are there, starting from validation, verification to issuance, then trading, and finally the retirement. Everything comes onto the one single blockchain ledger, gives a complete transparency of the entire traceability that is there in the market. And that gives a real-time tracking of supply and demand on the system, that whether the issuance have been happened or not, and whether the retirement is being required currently. So this is one of the things that can be provided with blockchain technology. The another thing is the automation that can be included with the help of smart contracts. Automatically, smart contract can provide the supply that, for example, there is a new issuance in NBS credit, that can be directly provided to all the sellers, on the platform itself, that gives a demand drivers for that particular kind of credit. So that is my take about the technology.
Very good. Vish, I know that ASEX also has a blockchain platform. I just wonder if you want to complement something from your own experience working in so many jurisdictions.
Yes, so I think blockchain has been instrumental in giving credibility to the asset. So, like Neha mentioned, the traceability has become almost a non-issue on a blockchain now. There was a lot of bad publicity around, double counting of credits and whether these credits were authentically generated, all of that. So that problem is solved with blockchain. The other thing that we've managed to solve is that we have a very efficient settlement mechanism, which is T0 settlement practically. So the trade is instantaneous across all our platforms globally. So whether, if the seller is in Brazil and the buyer is in Singapore, the transaction is seamlessly completed on the same day itself with full traceability. So I think the efficiency and the cost efficiency that it creates has given an opportunity for volumes to be driven on these marketplaces. The other thing that that has happened is that rating agencies like B0 and Silvera, all the credits are now rated on the platform. So the ambiguity around the quality of the credit also is being addressed, and I think that is more or less most buyers are now very comfortable with the quality of the credit. So all in all, I think these measures have helped improve the efficiency of the market, the traceability and characteristic of the credits that you're buying, and also independent third-party products like rating agencies, insurance, etc., have made it a very credible market. And I think buyers are deriving comfort from that.
Thanks. So now, Judge, let me bring another dimension here to the discussion, which is, as we digitize and bring this kind of transactions into the digital space, then issues of data management, confidentiality, becomes important for buyers. So because they may need to have the certainty that they'll have the same kind of protections if they try to do perhaps a bilateral transaction with a party they know. So how do you see the market participants engaging on this space, and what does the system need to provide to them in terms of comfort with the data, privacy, and confidentiality for them to really embrace these platforms and participate actively?
Yeah, thank you, Fabio, for that question. I think it's quite a layered question, so I'm going to try and break it down, and I'm going to consciously remind myself to speak slowly because I usually shoot it through. So I'm going to start with the fact that it's really pertinent for us to understand that the market that I'm speaking of, so in this case the voluntary market, has always ran in the manner that it is for the concept of protecting sensitive information. I think we all understand that, but I think it's good for us to understand why. So I'm going to try and give a context, and then we'll break it down together. So just last year, the World Bank released a report in 2024 that 1,500, so 1,500 companies have started to adopt different forms of carbon pricing. Now, if you look at 1,500 compared to the globe, it's a fraction. It's a wee little fraction. Right? And it all really comes down to the disparity that exists in the market. And maybe for a lack of better word, I'm using disparity, but what I mean is the price of carbon credits versus the price that a buyer is willing to pay. Now, this disparity has caused a lot of transactions to happen over the counter. And that's just simply because traditionally, historically, it allows a buyer to negotiate and protect their sensitive information on a bilateral manner. But that's not the issue here. What I'm trying to highlight here, and sometimes we tend to omit from discussion, is that the point that is similar in everything that I said above is finance, is budget. Budget is one of the most influential factors for decision making. Be it you, be it for your household, be it for a buyer in the carbon market. So if you think about it that way, price transparency is a reaction to a market condition. And the lack of transparency is also a reaction to the market condition. Now, I'm going to try and give a quick breakdown, so bear with me. Today, majority of the companies don't really have an internal price for carbon, which essentially is the evaluation and measurement of an emission-related cost and investment measurement that is set aligned to their value chain, right? Why? Simply because, that's a lot of words that I said there, but simply because the financial capacity of a buyer always will remain at the discretion of the buyer. So how can we really balance that? I know I'm sitting here with a lot of tech providers and platform, so I'm pretty sure there is a blockchain technology out there that is able to anonymize price data whilst still maintaining that confidentiality of that transaction. So we do already have the solution, we do already have the tool, but I'm going to challenge that because of the market condition and because the maturity is not there, we don't have the price transparency. One last thing before I end off. Whenever we speak about price transparency, I'm pretty sure all of us are thinking about buyer and seller. In my opinion, price transparency in the voluntary carbon market should go beyond that. It should be on the pertinence of ensuring carbon finance is churned to the right stakeholder. And in the voluntary carbon market, that is always going to be the impacted community and the environment. So I think we should always start from there rather than the price of the buyer and seller. So I'll stop here.
Thanks, Nadia. Maybe if I can pick on this point that you said in terms of handling the data and trying to find this balance on confidentiality and how do we make sure that people are comfortable in participating in that. We have the experience of exchanges that have been dealing with that very problem, in many other commodities and financial products. So maybe, Indranu, if you could join the conversation and share a little bit of your experience, both ICX, but also, with the experience even in the development of the power sector in India. What role can exchange play in the carbon market? How do we provide these assurances to buyers and sellers, and how do you compel them to participate in these central trading platforms so that we have actually, the necessary liquidity to create the price discovery that Nadia was referring to?
Thank you. Thanks, Fabio, and good afternoon to all. I think that's a lot of questions that's there. So I'll try to break the answer into parts. So firstly, on a very fundamental level, we say that what exchange brings to the play. So exchange brings two things. It is trust and transparency. And for transparency, I'm keeping it restricted to price discovery only. I'm not going to the stakeholder realization and other things. So exchange brings these two things into the play. Now, what are the function that exchange does? Traditionally, exchange does two functions. First is price discovery and second is clearing and settlement. So these are the two fundamental functions that any exchange across the world does. Now, price discovery is the output function. So what is the input function? Input function is the algorithm. Input function is the different auction methodologies that are there. So normally it's a closed double-sided auction methodology or a continuous matching methodology or a reverse auction methodology that helps to discover the price. Now, in order to run all these auction methodologies, you need some support from the market in terms of the liquidity, in terms of the people coming in, participating. So we'll come to those things gradually. Second part that exchange plays very, very importantly to bring a lot of confidence into the market is the clearing and settlement. It's a very basic fundamental function wherein it is ensured that if there is a trade that has taken place, so the realization by the seller is not deprived of the realization, the buyer is not deprived of the products. And there is a timeline, within that same timeline, this has to happen. This is where the exchange differentiates from the OTC. Now, you see a lot of OTC transactions, they are being settled on exchange. This is specifically because of this reason that exchange brings a lot of trust into the business through its robust clearing and settlement mechanism. Third part where I see a lot of role that the exchange plays, and it's very important for the carbon market, is to standardize the contracts. See again, exchange thrives on liquidity, and liquidity is only possible when you have a homogeneous commodity. Electricity, be it nuclear, be it renewable, be it thermal, be it geothermal, whatever, unit is kWh. Gas, whatever is the source, whatever is this, unit is MMBTU. But carbon is not carbon. Carbon has all those 17 SDGs, specific requirements. Somebody sitting in US wants a carbon from 2018 vintage of a particular project in Madhya Pradesh on a cook stove basis. This all makes this entire thing very, very complex. Now, the more fragmentation we have in the products, the more price discovery becomes difficult, market efficiency gets hurt, product realization gets difficult, and the more market creates for OTC and opacity in the market. So my understanding is, so when an exchange comes in, it essentially brings in three parts into it. So first is price discovery, which is the output. Second is clearing and settlement, very, very important, keeping both the parties guaranteed. And third part is standardization of contract. So the way, if we are able to do these three things, I think for our marketplace that we are planning to have, we'll be able to create a very robust structure from the beginning itself.
Thank you for that background. So let me build on that, and I think, let's say we solve for that. The question then is, how do we make sure that investors and buyers, and other players come in, right? They join and sign up for digital platform. Avish, I think ACX has been doing that for some time, in talking to investors, to buying, interacting, to compel them to embrace a new digital marketplace like ACX. So can you share a little bit from your standpoint, what would facilitate that? What the stakeholders need to do, what you need from regulators, what we need from policymakers to facilitate the confidence from investors and buyers and sellers?
Yeah, so I'm going to break this up into two distinct parts. The first is, of course, we've heard about standardization and liquidity and all of that, which creates a more robust and a deeper market. One of the things that we've been pushing for regulators worldwide is the fact that these carbon markets are not just an instrument to offset your carbon footprint. I mean, that's the minimum that they can do, right? I mean, that's the lowest hanging fruit. But what we believe is that the carbon markets can be used very efficiently to raise large amounts of capital and harness kind of capital flows towards the entire transition to the net zero economy. So to give you an example, let's assume you have a project which has a very high embedded cost of carbon, let's say a carbon capture and storage project, requiring a large amount of capital upfront, and requiring it to be monetized from the revenues that are going to be generated from the sale of the credits. Now, this is a typical project which needs an exchange type of platform to get, go to market, raise the capital, deploy it, and ensure that the credits are then passed through the exchange to the buyer. Now, this is an example where, an efficient market which channels capital inflow into projects of this nature, which need the capital upfront, but are, require long gestation periods, can be, financed through the carbon markets. So this is one thing that we are pushing the regulators to do, that use these markets as a means for harnessing capital, not just for offsetting and making your operations carbon neutral. The other thing that we have been pushing regulators worldwide for is an integration globally for these markets, because it's a completely fungible product. It can be produced somewhere, it can be consumed somewhere else, and if you look at it as a financing mechanism, then the fact remains that global fungibility of this particular asset becomes absolutely essential. So we need, and I think Indranil will agree with me on this, but what we need is global connectivity to ensure that we have better price transparency, better liquidity, better standardization, etc. And the other thing that we need is that we need a very strong secondary market which will drive capital to come in, because unless capital can make money by investing into these kind of asset classes, the liquidity on these asset classes don't come. And so we would need these markets to be used as a means to channel this and through the secondary market transactions.
So, Dr. Jain, your company advises other companies in their carbon strategy, and you have the marketplace. So, picking on Vish's point here, how do you attract buyers and investors to the market? Is there anything that can be done to facilitate the decision making, to accelerate decision making, using even some of this technology, or sharing better information to bring them to the market? Because one of the challenges so far in the offset space, as all of us involved in the market, has been the softness in the demand. So is there anything that we can do to with technology to try to facilitate or accelerate that process?
Yeah, absolutely. I think one of the biggest reason that why we require technology is a global reach. It is very difficult being a consultant. You can reach out and explain each and everything that why this is like this. In fact, standardization is not up to the mark. We are dealing with a lot of industries, various different types of sectors are there, and they have their own type of mechanism for having a decision that which type of credit I should purchase and what type of goals I should achieve, and then finally depending upon the consultancy, which is not the right thing. I think only for aviation we have a set standard rule in terms of CORSIA mechanism, but rest of the industries are still struggling. For that, I prefer and I always try to recommend a recommendation system that should be there in the digital platforms like BNZX, where industry-specific requirements can be directly projected based on what are their requirements. They should not be bothered about heavily flooded data of other industry and other type of projects that are available. Right set of carbon requirements should be there in front of them so that they can easily take the decisions. Like for example, if someone wants to look at what type of co-benefits I'm going to have, if the project I'm buying, whether they are actually emitting, how much of, they are actually, sequestering, how much carbon emissions and all kind of information should be there at one place, along with very important feature, which is a price benchmarking, which we try to provide for both buyers and sellers, that these are the global prices that are there as a benchmark. So when you are listing something onto our platform, you should be aware of what exactly you are putting in. And also at the time of buying, you should be aware that you are not buying in a heavy price or cheaper price or something like that, which I feel traditionally I would like to, remove the third party or the intermediaries so that the buyers and sellers can get the exact benefits. And that is why I try to, bring these kind of recommendation, platform-based recommendation system as a tool. One another feature which is very wonderful and it is, provided, I've got some feedbacks onto for my system. It's not just the rating mechanism from B0, Silvera and all kind of things can add value, but the user reviews and user ratings, if we are providing it, the previous buys that, that whether that is useful for them or not, are also going to provide much confidence that yes, this is something that is widely acceptable and it can be, having a, and I can make a decision based on that particular thing. So these are the things that should be there in the digital platform.
Very good. Indranil, I'll expand a little bit on the point that she mentioned on the issue of reach, right? And you and I had a discussion earlier that your discussion was who should participate in the carbon trading, right? And should be only domestic entities or international participants as well to try to increase liquidity. Do you want to comment on that from your standpoint? What to be the right way to approach the development of the India market is something that should be open to many participants since carbon is a global commodity, or more restrict? What would be your view on your experience there?
See, again, I'll try to answer this in two parts. So one is, see, we already have a lot of experience in running the environment market. So environment market in India has been functioning since last 15 years. We started with the REC market in 2010 or 11. The ESERTs, the PAT market is functional since I think 2012. And from a market perspective or from an infrastructure perspective, we are very well placed if we are considering a domestic market. But now, since Neha is there, Vishwajit is there, so now with blockchain and expectations of people, requirements of traceability, this kind of things kicking in, these things needs to be incorporated in our market if we want to get larger sets of participants to come into the market. And secondly, again, market runs on liquidity, very fundamental. So liquidity is supply and demand. India has always been a supply-heavy country. Earlier on the VCM days also, I think we are supplying close to 30-35% of the global VCM credits. So we'll remain always heavy on the supply side. So it will always be a seller's market in India. Now, buyers market, if you ask me the domestic buyers, so the demand has to come from the buyers. Now, who are the buyers? So buyers would be, as per the Energy Conservation Act, now they have included the commercial buildings. So some of these people will come in. CBAM would be one of the major drivers. So these kind of people will again be coming. Some of the people who are, who has this export-oriented units, EOUs, they will be participating. But will that be enough to drive a complete voluntary basis offset market? So that is the question. So for that, my understanding or my opinion is it is always better, it's the best to open the market to international participants. Let major buyers come in and participate. We need to develop a framework for that, whether it is possible in our jurisdiction or whether it is possible in the gift city jurisdiction. Those things we'll have to dwell and finalize. But it is very important if we want to drive a healthy demand in the market. And as a developer, I am expected to get the best for my product. So I'll only come to this market if I see that I'm getting the best of the best prices. So that liquidity can only be driven by the international large-scale buyers. And I think some enabling mechanisms are absolutely needed for that, firstly. Secondly, what Vishwajit was saying, again, we see EU ETS, we see the Australian ETS, New Zealand ETS, and we see the prices. EU ETS prices are always benchmark. But we need to understand that primary market forms a minuscule part of that. It is the secondary market that completely drives the price. So if the price of a commodity in EU ETS carbon is, say, $80 or whatever, so 60% of that price is driven by the secondary market. 40%, 30% is only by the primary market players. So we'll have to open our market to the hedgers, to the traders, to the people who would be taking positions. So I think these things are imperative if we want to create a real vibrant marketplace for the product.
Thanks, Nuzil. Amit, we talk a lot about the buyers and how we bring buyers and investors to the market. GCC in a way is a bit of enabler of the supply. Work with developers, the standards, et cetera. And I know there's a lot also in initiatives in applying technology to simplify the process, accelerate the process. So could you share a little bit with us what GCC has been doing in terms of applying tech to accelerate the supply, create integrity, more integrated supply, and help with this process of create more price transparency and in the global carbon market.
Yeah. Thank you. So firstly, in terms of supply, we're close to 1,500 plus projects, and I think close to 120, 130 have been registered as of now. About close to 600, 700 projects are still under validation. And close to 300 projects are under assessment as of now. Many of the projects have not come back for, let's say, more than a year. So we cannot conclude on whether or not they will meet the requirements or they will be ultimately registered or not. So in terms of the credits total, we have more than, I think, 12 million credits issued as of now. We have close to another 10 million in the pipeline. We expect close to 25 million to be issued by the end of this year. So I think this is in terms of the supply that we are looking at as of now. Because we're CORSIA first phase approved, we have information that certain countries have started issuing the letter of authorization, so which means that there will be a big boost for CORSIA first phase markets. So some of the countries like Vietnam, Uzbekistan, Nepal, Pakistan, and other countries, Oman, we have heard that they are already issuing these letters. In terms of the initiatives with regard to the IT-related initiatives, so we have recently launched GCC 2.0. We call it second generation GCC. What we have tried to do is we have tried to have a unified workflow where we can integrate all the requirements like CORSIA, first phase, pilot phase, ICBCM requirements, or maybe ICROA and other requirements. For example, some requirements coming from the government of Singapore, carbon tax. They have a carbon tax, where there's other requirements. So we try to have a single window kind of opportunity for project developers to actually choose what they want and which jurisdiction they want to target for achieving their carbon finance at a later point in time. So I think once they choose that, those requirements will become requirements against which the verifiers will do their assessments, and finally the projects might get registered or credits might be issued. So there is a lot of flexibility in terms of different labels that are coming, and also these days, as I talked about, there are for pricing the carbon, obviously there is information that has to be made available to the buyers, and I think Neha talked about it. I think there are new requirements that are coming up because we are in a constantly changing carbon space. The requirements like whether or not the letter of authorization has been issued, whether or not the country has Article 6 frameworks already established, whether or not the corresponding adjustments have been already verified or not, or whether they are thinking about going in that direction or not. So I think there are new requirements that are coming up on daily basis. There was, I think, in Baku, there was, this electronic format for reporting that's used to be used by countries for reporting the corresponding adjustment and their inventories. So in that, there are new requirements coming up. We see that there is a need to report on each and every type of greenhouse gas that gets emitted, rather than you having an aggregated requirement of reporting the carbon dioxide equivalents, the conversion. So I think new requirements coming up with new requirements such as the this cooperative approach, identification numbers, which means that the two countries have to have a cooperative approach before they enter into Article 6.2 space, and they have to submit it to UNFCCC to generate that reference number. So I think there are a lot of information that has to come up, and this information has to be digested and first of all provided in a transparent platform for everyone to look at, everyone to understand, and then accordingly price this whole thing. So I think these are some of the initiatives that we're doing, but lastly, I would like to touch upon one recent initiative with regard to the World Bank's Carbon Access Program. Is a $15 billion program where they want to provide energy access to 32 African countries. And then there would be a new standard that would be set up, which is called the World Bank's Carbon Energy Access Standard, that will actually factor in, I would say, DMRV, real-time issuance, reduce the roles of verification to a greater extent by focusing on validating the DMRV system, the reliability and robustness of those systems, rather than visiting each and every site at every time. So this probably will reduce the transaction cost. This will be a very innovative concept in carbon markets, because then carbon markets, players like Corsia and others, they always believed in having independent verification. So
understood.
Yeah, thank you.
Thanks, Amit. So Nadia, before we open the questions, Jonas, I'll ask you the final question of the panel, and maybe about a little bit of crystal ball gazing here. So a lot of the price variation that we see is more prominent in the voluntary market. We know that in the compliance markets, if the ETS, European allowance is European allowance, or California allowance, a California allowance, and the price outside of the time value money is one product, one price. Now we're starting to see the emergence of compliance demand in carbon markets also through 6.2, Corsia and other examples. So with that trend in the market, the emergence of the compliance demand, is that also going to force some more transparency on the price, some convergence on the price? Are we going to see a more narrow band in the offset price in the future? What would be your views there?
Yeah, thank you for the question. Before I answer it, I just want to put a disclaimer. I'm no oracle, so this is purely my opinion on how I think it will turn out or pan out. Essentially, inevitably, I do see a growth in price discovery, right? Meaning a reduction on the transparency that we label the market to be. However, there's a but, to a certain degree. Simply because I think, like my fellow panelists, speakers have mentioned, a lot of the market that we are in today runs through the secondary market. And a lot of the secondary market is based on negotiations, discussions, and there is an element of price transparency that will always be there. And I still think, despite the market conditions, it will always be there. Now, what will change, of course, will be the guidelines, the standards, the parameters that drive that transparency to maybe a bit more of a guided nuance. So I think that's one. Number two, obviously it will grow because I think there will be a convergence of enhancement and adoption of technology that will allow for more price discovery, as we discussed, as well as regulatory clarity. So I think these two factors, to a certain degree, will bring it forth. Now, I don't remember the second part to your question, but I think it's on, is it on the scalability?
Well, it's just the question, I think you addressed it, which is, if the compliance demand coming, are we going to see a more narrow price range?
Yes and no. How do I put it? For the compliance market, you know the price point, as you mentioned earlier. Now, there is a convergence, right? Or some people might call it pre-compliance or interoperability of the market. Now, the point where that market is interesting is when that price point is below that compliance market, right? And if you have that price discovery to a point where everything is standard, then that may not make it as competitive. So even if you take Singapore carbon tax, if the tax is at 25, anything below 25 for that 5% of the obligation will become interesting. And in my opinion, I think that will really depend on the project, the technology, and there's just a lot of factors that will not drive full price transparency, but it will enhance a form of price transparency. Either I've confused you all or made it better, so I'm hoping it's the latter.
We shall find out with the Q&A.
Exactly.
Okay, thank you everyone for sharing your perspective. I'll open the floor for questions. We have 1, 2, and 3 questions here. Let's take all at once, and then if you could just introduce yourself briefly, and also if you direct it to one specific panelist, just please note that.
Thank you, sir. My name is Mukesh Singh, and for a point of view of an RE developer, especially voluntary carbon markets, when I say about the prices of a carbon unit, I find it very difficult to find what exact price is going on the market. So as we discussed, the voluntary carbon market is very much compartmentalized. It is again based on the nature of the carbon offset, then again based on timelines. So I believe there are things which already discussed. It I believe lacks the kind of credibility and transparency, and again to some extent lack of any statutory backing. So just my question to entire panel is, do we see in a near future that the entire, especially this voluntary carbon market, will be backed by any statutory governing body? Number one. Number two, can we see is the market's prices finding as easy as finding prices on a stock exchange, or for example, say, any exchange which we operate, okay, power exchange or stock exchange.
Okay, understood. Thank you for the question. There's a second question here, then we come to the front.
So my name is Vineet Sagar, and I am co-founder for Carbon U-Turn. My question is to Dr. Neha Jain. What we believe is there are many blockchain technologies. Do these technologies talk to each other, and which technology have you patronized? The second is, we believe that blockchain is very energy intensive. So what is the carbon footprint per carbon credit which you are pursuing, and how do you offset it?
Okay, good. And then we have a third question here.
Good afternoon to the panel. I am Mohit Chaube, and last year I completed my master's dissertation research on designing a global carbon pricing and market system. And I wish to know the panel's view on a dichotomy which I see in the demand of carbon credits. So when we talk about businesses which are outside a compliance market, the more climate conscious or green they wish to show to their investors or to their consumers, the more they are likely to buy a carbon credit. Whereas businesses which are under compliance markets where offsetting is also allowed, the more climate conscious they are and they want to decarbonize themselves, the less likely they are to purchase offsets, because offsets is a way of cost cutting. So do you think that this is going to create some distortions in the demand? And also, do you think that this dichotomy should be resolved? Thank you.
Okay. So, Dr. Ned, do you want to answer the first one on blockchain, since was Dr. Jain was appointed to you? do an answer that first, and then we open the other for the panel. Yeah.
Yeah, so I'll address to the second question. This is what you're saying. Okay. Thank you very much for highlighting that blockchain technology is definitely power consuming, but just in other businesses, if you ask me, other technologies or maybe the cloud technology or any other servers, if you are utilizing, they are all at the end businesses, and they are trying to reduce their carbon footprinting. Like Google is reducing their cloud footprinting and all kind of things. So similarly, all the blockchain, public blockchain, I would rather say, like Polygon and all, they are also trying heavily onto reducing the carbon footprints. And right now, they have utilized greater mechanism which is not as power what you can say, power utilization, like there are Bitcoin based blockchain, proof of work I can say rather, but now they have changed the technology. It is proof of stake and all kind of things. So that is definitely improving in that way. For us as a company, we are definitely relying upon the public infrastructure and trying to seek and we are blockchain agnostic, by the way. We are trying to utilize every single type of blockchain, including Fire and other blockchains, those who are having a very comparatively lower carbon emission. So that is something that is our approach to reduce the emission in a business perspective. But moreover, my emphasis towards utilization of blockchain technology is not the how it is being operated, but the underlying power that a blockchain has for providing a decentralized approach towards a centralized control on the system. That is something I was focusing upon to bring more transparency and traceability.
Yeah. Thank you. So who would like to take their two questions on the RE pricing and the other one on, I think, corporate behavior towards offsets?
I'm happy to try both, but maybe we can try. But sir, I'm so sorry. I have a goldfish brain, so I kind of forgot your full question. If I understood it correctly, you are a RE developer, and you feel that the carbon markets are being unfair to...
In near future, are there any chances where the prices are as transparent as, say, stock exchange or power exchange?
Okay, I'm going to try it, then I think, yeah, okay, perfect. Yes, the short answer is yes. There are countries whereby the voluntary market is also regulated. Actually, if you take into India, you have your compliance market and now the offset market coming, and you have methodologies that are recognized under the voluntary space. You have countries like Indonesia, which is pretty much similar. All projects that are developed out of Indonesia follow the local methodology and schematics known as SRN. So in some ways, there are ways to regulate any form of carbon market by any regulatory body within a jurisdiction. It just really depends, because it's also a financial cost if you want to create your own, or you can tap into existing infrastructure that exists. I hope I answered it. Thank you.
I would also like to add. So you asked about whether or not the carbon markets would be regulated. So one part of the carbon markets is the supply side, where the credits get created or issued. So I think that is already regulated by players like CORSIA or ICVCM or Article 6 bodies. With regard to the other side of the equation, where the transactions happen and how those transactions can be regulated, my understanding is that there were some initiatives in the US called CFTC, where there were some there is some observations, I think, that were also public. But I think it has to do with the volumes, in my understanding. So carbon markets, as of now, we are still at 3 billion, including both compliance as well as voluntary market. 3 billion credits have been issued as of now. 3.5 billion. So I think with Paris Agreement and Article 6, there's a need to have almost 58 billion greenhouse gas reductions or tons of greenhouse gas reductions by every year till the middle of the century and towards the end of the century. about NDCs, the plans that countries have provided, contribute to close to 29, 30 billion, I would say, every year. And there's still a gap of close to 20 plus billion that remains. And I think the carbon markets that are the new generation carbon markets that are coming up right now is expected to touch close to 8 to 10 billion tons every year. So which is almost 4 times size of the CDM combined for last 20 years. I think if this kind of volume is going to come up, how will manual ERPA be able to handle all those transactions? I think it's evident there has to be some kind of digitized platforms that would come up. There has to be smart contracts. They have the real-time settlements, have T+0 transaction time. I think this is, in my understanding, an obvious thing that to happen.
Okay, and then we had the third question about corporate behavior and use of offsets. Anybody want to comment on that? Anything there?
I wanted to answer
okay.
part B of his question, where he asked that whether we see price transparency in the carbon market same way as the stock exchange and the power market. So I think that's slightly further scenario from today's aspect, because this market has historically been developed as an OTC market. So it's historically a bilateral market, and the structure would continue to remain so for some time because of the, again, heterogeneity of this particular product. So carbon is not only carbon, it has the SDG part also built to it. But what I think BEE is doing, and what I think is already being practiced in India, is in the REC market, the REC market that we have already introduced multiplying factors. So today, wind REC, solar REC, and other RECs, so they all are binded together by a multiplying factor, so that every commodity, irrespective of its source, has some value at the same point of sell or purchase. So for carbon also, I am sure BEE would be introducing something like that, a multiplying factor or something like that, so that all these, I'll say, errors of the market or different choices of the market would be normalized. So this can bring, I would say, more transparency and more price transparency in the market. Yeah.
Very good. I'll just make one brief comment. We unfortunately run out of time, but I think there's a lot of research on corporate behavior versus offsets. What I'll point to, there's, I think, a very good piece of research by MSCI, which is a financial data company, who basically the outcome of the research was, the companies that are more engaged in climate action actually are the ones that tend to be comfortable with offsets. So the companies are not buying offsets to avoid climate action, but actually the more awareness they have and the more targets they have and more commitment they actually have, offsets is one part of the toolkit that they use in their targets. I want to thank everyone for, sorry, Nadia, do you have any? Okay, maybe after.
Maybe if I can have 2 minutes just to quickly answer. First of all, congrats on your masters. Just really quickly, I think it's good to know that the term offsets are maybe not fully understood. So for example, if you're a company and you have 100 tons of CO2 equivalent and you buy 50 tons of offset, under the greenhouse gas protocol, you still report 100. It's not a reduction in your accounting and your book. So I think that's one thing that I just want to clarify. Number two, because of, let's say, market conditions and what's been happening in the world, there's been two, let's say, good initiation. VCMI, that has the codes of claims, right? That helps companies make a reliable claim based on what they purchase. And then on the other side, you have ICVCM with core carbon principles that really try to drive high integrity carbon credits. So I just wanted to quickly add on to that.
Thanks, Nadia. So let me thank the panelists for the discussion. Thank you so much. Thank you everyone that took the time to join and participate in the discussion. And we can continue afterwards.
Yes, thank you so much. I'll just quickly hurry up, but we do want to felicitate our panelists and our chair and moderator. Thank you so much for this session. I would like to call upon Mr. Tushar from PwC to felicitate our panelists. We have Mr. Vishwajit Dhanukar. We have Dr. Neha Jain. Sorry, could we get a round of applause for our panelists, please? We have Ms. Nadia Nair. We have Mr. Amit Husu. And we have Mr. Indraneel Chatterjee. And finally, a special thanks to our chair and moderator, Mr. Fabio. I would request all the panelists and our moderator to come together for a quick group photo before we begin the next session. You can be part of the photo as well. Thank you so much, everyone. That was a very insightful session. Due to time constraints, we'll be starting with the next session almost right away. You have a quick water break for maybe a minute. Just to let everybody know, the session that will be taking place here in the family room is Climate Tech Startups for Sustainable Development. While in parallel, the session that will be running in the ballroom we were in earlier in the day is on ecosystem-based interventions for those who may be interested to attend that session. As for here, we'll be starting in the next couple of minutes. Thank you so much.